So imagine if this bar of chocolate is a stock. A 2-for-1 stock split means for every 1 share you own, you will get an additional share on top of it. So you effectively hold 2 shares in total after the split. Pretty simple, right? Anyways, putting that aside, I believe by now you must have already heard about the stock split announcement by Google and Amazon, and also the potential stock split by Tesla in the 3rd quarter of this year as well. And in case you have been living in a cave, Tesla's market cap more than doubled in the following year when they performed a split back in 2020. According to the Bank of America, since 1980, the S&P 500 stocks that have announced stock splits have significantly outperformed the index in the 3, 6, and 12 months after the initial announcement. Stocks that have split gain on average 25% over the next 12 months compared with a gain of 9% for the benchmark index. But before we get ahead of ourselves and just purely focus on the returns, I'm gonna break down the mechanics of stock split, why companies do it, and how it will affect you as an investor of the company so that you have a better understanding of the entire process. Trust me on this one, you will definitely walk away from this video knowing stock split is not solely for the sake of its share price. But before we begin, a quick tap of the like button down below will be very appreciated. Thank you so much for that. And without wasting any more of your precious time, let's dive right into it. So let's address the elephant in the room. What is a stock split? By definition, a stock split happens when a company increases the number of its shares to boost the stock's liquidity. So this is how it usually works. Step 1, we have the likes of Amazon or Google announcing that they are doing a 1-to-20 split, and usually this announcement will come during their earnings call, which is usually done on a quarterly basis where the shareholders announce the company's performance and upcoming business plans, yada yada yada. Step 2, once announcement is made, they will usually notify shareholders regarding the X date, and any shareholder that holds the company stock by the X date will be entitled for the stock split. And in this case, the X date for Google stock split is the end of trading day for the 1st of July. Step 3, this is the date where the stock split corporate action is being carried out, and if you are a Google shareholder by the X date, you will be given the additional shares on the 15th of July, and as an end result, you will have 20 shares of Google. So after the stock splits, the total dollar value of all outstanding shares remains the same because a split does not fundamentally change the company's value. What do I mean by that? We know that the formula of share price is the company's market cap divided by its number of outstanding shares. Assuming Google has a market cap of $1 trillion with a 500 million outstanding shares, that would mean it will be trading at a share price of $2,000 per share pre-split, hypothetically. So after a 20-to-1 split, and since the market cap of the company remains the same, we will have 20 times more of the current outstanding shares, which means 500 mil times 20 equals to 10 billion outstanding shares. And taking 1 trillion market cap divided by 10 billion outstanding shares, we will end up with the share price of $100 per share. So since the stock split doesn't really bring any fundamental benefit to the company's market cap or profits, why does the company even bother with this corporate action? Well, 3 main reasons. Firstly, liquidity. The companies do a split when the share price of their stock has gone up significantly, so much so that not everyone is able to buy them as easily as before, which means lower trading volume, aka lower liquidity. For example, Google and Amazon trading at $2,000 to $3,000 per share compared to Apple trading at its 140s. It's pretty obvious which stock is more accessible to a larger pool of investors, right? Now, of course, we know that even though there are some brokerage platforms that now allow you to buy shares in fractions, which means you don't have to buy at least 1 full share. Shout out to Interactive Brokers, great broker, check it out, links below. Anyways, there are still many other brokers that don't provide fractional shares trading, like TD Ameritrade, Saxo Bank, Tiger Brokers, Momo, and etc. And to make things worse, some countries make it harder for retail investors to trade foreign stocks as they don't want their own stock exchange or currency to be cannibalized. Yes, trust me, they do exist. And to my previous point of the shares of the company becoming more affordable to a wider base of audience, it all also indirectly affect the psychology of the investors as they are now able to afford the shares, and that also helps in building the investor base of the company that may end up converting into a hardcore supporter of the company.
Let's take a closer look at iPhone 13, starting with design.
Since when you ever talk smack about a stock you own? Never, right? Companies that went through stock splits generally have a positive outcome in the long run. For example, Amazon's share price jumped more than 5% the day after announcing a 20-to-1 split alongside its share buyback plan. And when Tesla said that it's planning for a stock split in 2022, their stock price surged 8% on that day itself, adding a whopping $84 billion to the company's market cap. And just for comparison purpose, $84 billion is equivalent to the market cap of Starbucks Corporation. Talk about the amount of hype a stock split announcement can generate, especially for trending stocks like Tesla. However, it's not all sunshine and rainbows, because if that's the case, every company will be splitting their shares left and right. Based on historical data, I found out that the stock prices may fall off after the split is completed. For example, Tesla announced its 2020 split on August 11 and their share price rose right up until the day of the split, August 31st, only to fall in the days that follow. And the same applies to Apple with their previous 4-to-1 stock split on the 31st of July 2020. The stock began trading on a positive trend upon the announcement, but then it pulled back as well, much like Tesla, which is a pretty common phenomenon known as mean reversion, which means that what goes up must come down since most hype and trends are short-lived. The third reason why companies perform a split is to qualify to be included in the Dow Jones Industrial Average DJIA index. Take Google as an example. They are currently excluded from DJIA because the Dow Jones is a price-weighted index. In other words, the index requires listed stocks to have roughly similar share prices. Otherwise, the higher price companies will have more influence on the Dow's direction and could have a disproportionate weight among the other small list of stocks. I did a quick calculation on the top 30 holdings of the Dow Jones, and the average price is approximately $162 per share as of the recording of this video. So now imagine inserting Google and Amazon into the index, each of which trade well above $1,005 per share. That would totally skew the index too far away from the remaining 28 companies, right? Now I'm sure you must be asking, why even bother joining the DJIA? Well, by doing that, you are putting yourself as part of the index that represents 30 of the most highly capitalized and influential companies in the US economy, on top of being one of the most established stock market benchmark alongside the S&P 500 and Nasdaq. And as a bonus, the company will gain access to more capital from the Dow index as the committee needs to buy into the company's share as well, which also translates to higher market cap for the company. But of course, the Dow's $37 billion size is pale in comparison to the $13 trillion investment in the S&P 500 index, but it will never hurt to have more capital, right? So once a stock split is done, apart from having more shares in your brokerage account and the unit share price have gone down significantly, how does a stock split affect you, to be exact? Well, once the company's stock prices have become more affordable, it can be easier for individual investors like us to rebalance and readjust our portfolio weightage, as each trade now involves a smaller percentage of our overall portfolio. And you can even say that it's now easier to rebalance your portfolio to achieve your desired weightage. Besides, stock splits will also affect the options trading market as well. We all know that the stock market doesn't trade in round lots of 100 shares anymore, but the options market still does. Which means if you want to buy call options, for example, you have to buy them in contracts of 100 shares each. So imagine buying into Google shares pre-split of say $2,000 per share compared to a post-split price of $100 per share. This will definitely change the way how option traders approach their trading strategy and whatnot. But of course, keep in mind that since there is a significant increase of liquidity in the options being traded post-split, that also means that there will be higher volatility in the share price as well, which is precisely the reason why Warren Buffett refuses to split his Berkshire Hathaway A shares that is now worth over $400,000 each, in the name of deterring traders that are looking to make quick profit out of it. So wrapping up this video, whether you buy the stock pre or post split, it doesn't really matter, because a stock split doesn't change the fundamentals of the company at all. I personally invested in Apple before its 4-for-1 stock split in 2020, and to be honest, it doesn't feel any different except I have more shares of it in the brokerage account while the unit price is reduced by a multiple of 4. Yeah, that's basically it. If you ask me whether you should buy on the announcement of a stock split in anticipation of a share price surge, I would say no in general, because that would be equivalent to chasing the highs, and you are probably too late to the party if you are buying based on the news. And the last thing you want is to get stranded at the top just to see the share price plummet when the hype fizzles out. Regardless of the stage of the split, I believe the focus should always be on the fundamentals of the company. Is our own thesis of the said companies like Google, Amazon and Tesla still intact? Are they still generating outstanding revenues quarter after quarter? Are they bringing in higher earnings per share with no signs of slowing down? If yes, just continue dollar cost averaging into the stocks, because fundamentals will prevail and you will be rewarded in the long run. Okay, that's all for now. I hope you found this video helpful. Thanks for watching, and with that said, stay safe, stay invested, and as usual, I will see you in the next one.